So, hello and welcome back to the CFA Institute Research Challenge Finals for the EMEA region. My name is Peter Watkins and I'm the Global Senior Director for University Programmes at CFA Institute, based in our London office. So, things are really hotting up. The just six teams competing today have already achieved significant success, winning their local competition, competing against all the neighbouring universities in their local region. They then went on to succeed in the second round of the competition based on their presentation and their excellent research analysis reports. Then earlier this week, they triumphed once again in the live regional semi-finals, offering superb presentations and surviving a lengthy question and answer session with panels of expert judges. We really are seeing the brightest and the best finance students from right across Europe, the Middle East and Africa. Congratulations to you all. I would like to thank our sponsors, London Stock Exchange Group, for providing access to their invaluable data service platform and an authentic learning experience for all the students competing. I'd also like to thank our volunteer panels of expert judges who have given their time and considerable commitment to support the development of all these future investment professionals from right across this region. Our judges are firm, focused, and fair, and we are very grateful to them all. Now, to the details. Everyone is currently in the main session room. Throughout the event, we will move participants as appropriate to virtual breakout rooms where the presentations and question and answer periods for each team will take place. All teams, beside the first presenting team, will be moved to their own individual rooms when the presentations start. Teams should remain connected and present in these rooms until they're moved to the presentation room. After your team has presented, you may disconnect and rejoin for the advancement notice or announcement at the end. Only timekeeper, teams and judges should have sound and video enabled at any time. All other attendees should remain muted and with your video off. A 1-minute warning will be provided for the presentations, but not for the Q&A period. As a reminder, the Q&A period for the regional final round will be up to 15 minutes. For the best viewing experience, we suggest hiding non-video feeds. There are many viewing options, so we suggest taking some time to find a view that looks best for you. So, the teams competing today are Kosminsky University, representing CFA Society Poland, University of Naples, Federico II, representing CFA Society Italy, University of Jordan, representing CFA Society of Jordan, University of Lagos, representing CFA Society Nigeria, Qatar University, representing CFA Society Doha, and WHU Otto Beisheim School of Management, representing CFA Society Germany. The judges today will be Mark Temnikov, CFA, Serkan Uzan, CFA, and Olivier Müller, CFA. Adrienne will be our timekeeper. At this time, we will start moving judges, guests, and then the first team into the presentation room. This may take a few minutes. We wish you all the very best of luck with your presentations. Thank you.
Hello, everyone.
Hi.
Kosminsky University, is your whole team here?
Yes, could we please check if you could see our presentation correctly?
Yes, you can go ahead and launch your presentation and make sure it is working properly.
Okay. Can you see it on the whole screen?
Yes.
Would you mind if we checked the first animation, the presentation, if it's correct as well?
Yes.
Okay. Okay, from our side, sounds good. Team, are we ready to start? Judges?
Yes, we are.
Okay, before we begin, please stay muted unless you are speaking. I will start time as soon as a member of your team speaks their first word. You will receive a 1-minute warning and time will end precisely at 10 minutes. Please feel free to begin.
Good afternoon. Wirtualna Polska is a leading, data-driven technological holding based in Poland, operating in e-commerce, media, travel, and advertising segments. We are issuing a buy recommendation with the target price of 138 PLN per share with an upside of 24%. Imagine your daily routine. You wake up. During breakfast, you catch up with the latest news. During work break, you check the results of latest sport events. Evenings bring a varied spectrum of entertainment. Sometimes you listen to the audiobook everyone has been talking about lately. You want to relax and listen to music on the radio or watch a TV show with your loved ones. You cannot wait for holidays, so you browse exotic travel destinations. Or maybe this year, you prefer to rediscover the beauty of your own country. Recently, your life quality improved as you got a salary raise, so you start looking for a car you wanted for years. Going with the flow, you start checking your creditworthiness. You can finally afford to move to a suburban area, so you search through the available house designs on the internet. This is Wirtualna Polska, your companion in everyday digital life.
Wirtualna Polska operational framework is strategy aligned with the systematic collection and utilization of data. The company operates in multiple business segments, selling online advertising space both externally and on its own platforms, offering subscription-based entertainment services, and being a travel intermediary in Poland and Europe, collecting fees on selling trips. Moreover, the company holds a fee-based customer finance platforms, e-commerce, and house design services. Each business segment holds a distinctive, competitive edge within its respective industry, highlighted by social media recognition, which is especially important when it comes to the data-driven company. The company's market presence and brand visibility positively influence its financial performance. Wirtualna Polska stands out with its impressive EBITDA margin and return on invested capital compared to the competitors, showcasing its efficient resource utilization and investment returns. Looking toward the future, the company's strategy is built on 3 pillars: organic growth, mergers and acquisition, and operation excellence through utilization of its ongoing research and development activities.
Customer data is crucial for developing business segments, allowing the company to identify target groups and enhance product and service performance for these groups. Since 2019, Wirtualna Polska leads in terms of number of real users in Poland, boasting the lowest coefficient of variation among competitors, indicating consistent customer attention and minimal risk of fluctuation. The company's services rank first in terms of reach nearly 70% of the time, outperforming its competitors. This stability is not due to declining interest, but to growing user numbers in recent months on the Polish internet, showcasing Wirtualna Polska's ability to keep a significant audience. The company maintains its leadership in Poland with engaging content and solutions, leading in average time spent on its platforms among local competitors. Mergers and acquisitions are yet another extremely important growth driver for Wirtualna Polska. Over the last 6 years, the company has acquired 20 companies for close to 900 million PLN, which places Wirtualna Polska way ahead of its competition. With deals made in all of its business segments, the company added 75 million PLN of EBITDA and 300 million PLN of revenue to its financial statements. However, the more important is the geographical expansion that will result from M&A transactions, with its first cross-border deal made in 2022. This serves as an answer to the potential threat of high cannibalization of data in Poland, as the cross-border acquisitions could provide an outlook on a broad potential of internet users. With the help of its in-house M&A team, Wirtualna Polska aims to deliver more acquisitions in the coming years, with more than 600 million PLN planned for the future deals.
The expansion is also reflected in the financial performance. Diversified portfolio of revenue streams results in a greater financial stability, and our forecast assumes the revenue growth to continue. Main sources of Wirtualna Polska costs include external services, which differ between the segments, salaries, and cost of goods sold incurred only by consumer finance and other segments. Wirtualna Polska was also able to keep the capital and assets effectiveness, which can be seen in increasing ROE by 2 and ROA by 3 percentage points. Focusing more on investing in R&D, Wirtualna Polska can reach improvement and create more content, which will lead to improved EBITDA margin. The highest EBITDA margins are observed in advertisement, 45%, and also travel and subscription segments. All of the segments are highly synergetic. Moreover, majority of the recent investments were financed by debt, and at the same time, Wirtualna Polska managed to maintain a lower debt-to-equity ratio than its competitors, and that is why we expect an extra capacity for future investments financed by debt.
Concerning ESG, we consider Wirtualna Polska as a leader both in Poland and among its industry peers. The company managed to successfully cut its Scope 2 emissions by 91% in the span of 4 years. It was accomplished through the acquisition of photovoltaic farms, powering Wirtualna Polska's data centers with green energy. In governance, Wirtualna Polska is also a leader with 31% women on the board. It has a highly experienced management team, with Jacek Świderski serving as a CEO since the IPO 10 years ago. However, the dual share structure enables the 3 co-founders to own over 50% of votes, despite owning merely 39% of shares. This might contribute to restraining further investments from institutional investors, which currently own more than 80% of the free float. However, the most material ESG topic for Wirtualna Polska is the social aspect. The company suffers from a high staff turnover ratio, currently standing at 23%. We believe it could be decreased by improving employee satisfaction through initiatives like closing the gender pay gap. It would then result in decreasing the costs of hiring process. The positive impact of this optimization project adds 1.64 PLN to our target share price. Furthermore, Wirtualna Polska's ESG performance is assessed positively by rating agencies and credit institutions. The company also benefits from a sustainability-linked loan program, allowing for bank margin reduction.
Our valuation of Wirtualna Polska is entirely based on the DCF model. By segmenting the free cash flows, we are able to accurately reflect the complexity and the unique business environment of each of Wirtualna Polska business lines. This approach enabled us to determine a valuation of 137.74 PLN per share. We incorporated scenario analysis in our DCF model. The optimistic case assumes better macroeconomic condition, faster technology adoption, and faster expansion. On the other hand, downside scenario assumes stronger macroeconomic pressure, increased staff turnover, and overall internal strategy underperformance. To assess the market sentiment, we performed relative valuation, with our base multiples being P/E and EV to EBITDA. We have identified comparable companies in each of the business segments and analyzed them based on the share of each segment in Wirtualna Polska EBITDA. Received prices suggest that Wirtualna Polska may be currently undervalued. The reason we chose not to include relative valuation in our final price assessment is due to the unique business model of Wirtualna Polska and synergies between the company segments. We believe that this distinction offers Wirtualna Polska greater potential than its P/E, further justifying our decision. To assess the price risk of Wirtualna Polska, we conducted a sensitivity analysis. It shows that the most impactful aspects influencing share price are changes in sector and market environment, what is reflected by the WACC and terminal growth rate. Additionally, internal factors remain important, with revenue and OpEx change causing the biggest volatility in the share price.
We identified 7 main risks that could impact negatively Wirtualna Polska's share price. The 3 most important ones being, first of all, the regulatory risk, as adverse changes in data protection laws would impact directly the company's core business model. Second, a return to high interest rates would increase the cost of debt, while OpEx would soar due to inflationary pressure. Finally, an increase of competition in the Polish advertising market would force Wirtualna Polska to decrease its margins, while operating expenses would increase. This is a risk that we consider rather unlikely due to the high entry barriers to this market and economies of scale from which the company benefits.
We state that Wirtualna Polska will further grow through its data collection capabilities, M&A expansion, and R&D utilization. We sustain our buy recommendation with the final price of 138 PLN per share. Thank you.
Thank you. Judges, at this time, please turn on your video. Please stay muted unless you are speaking. I will start time as soon as a judge utters their first word. The Q&A period will be at least 10 minutes. If it is still going after 10 minutes, we will continue for up to 15 minutes total. If any time after 10 minutes, the judges have no remaining questions, we will end the Q&A period before 15 minutes. Please feel free to begin.
Hi, thank you very much for your great presentation. My first question is related to ESG. How did your ESG analysis inform your valuation or your investment decision?
So in terms of ESG, like we said, we considered the social aspect as the most important one. So we incorporated this aspect into the valuation. Company currently suffers from the high staff turnover ratio. However, company sets the target to improve it, to improve both staff turnover and gender pay gap ratio. We put some assumptions connected with that company will improve staff turnover through improvement of the employee satisfaction and will invest on that, which will bring to the company negative cash flow. However, it will also allow the company to save money on the fact that they will not need to recruit more new people, not need to spend money on the recruitment process, and also new hires are statistically earning more money than promotions of the previous staff. So company would be able also to save money on that. Everything, our base case scenario assumes that company will move its ratios to the target it assumes. The negative scenario assumes that those ratios, those staff turnover ratio will remain higher, and then ESG adds a discount to our price. And a positive scenario assumes that staff turnover ratio will be decreased even to the average of its competitors.
Thank you. I'm adding a follow-up question. The shareholder structure you mentioned before, how did you reflect this in valuation?
So we believe that it is quite complicated to come up with a discount on the valuation due to the fact that the founders have more than 50% of votes. However, we think that it is important for any potential investor to keep this in mind. So we wanted to highlight this in our presentation. However, we did not integrate this into our valuation, just disclose it.
Thank you.
If we just go back, thank you very much for the presentation, team. If we just go back to ESG, did you do any research on what is the main reason for the staff turnover?
We tried to search something related to this, but we didn't find anything, as the company doesn't disclose much in this aspect. They disclose leadership trust index, which is quite high. So this is not related to this probably. So we think that it is mostly due to the gender pay gap ratio that is quite high. It stands at 8.7% currently. And that is why we think that closing this gender pay gap could help the company meet its targets in terms of staff turnover.
I would like to also add on that, because when we see the competitors of Wirtualna Polska in here, most of them are operating strictly in the media company, while Wirtualna Polska has more complex business model, and it may be also their...
Excuse us, I think we are having small technical problems on the side of the internet. Would you mind waiting for Bartek from our team for another 10 seconds so he could finish his thought?
Here.
Okay.
Can you hear me?
Yes, yes.
Okay, so I was referring to that. The Wirtualna Polska is quite complex holding with many different segments, and here we compare it. The main competitors compete with Wirtualna Polska mostly in the media segment. It's like here, like Agora, to give an example, is a company operating purely in the media. So this variety of business segments in Wirtualna Polska may be also the cause of the higher staff turnover ratio.
Okay, now that you mentioned the several sectors, which segments are most contested and what is the company doing to protect its market share or grow it?
So I think I want to clarify if I understand your question correctly. So you are asking if what segments are in the most danger for potential competitors to enter.
Yeah, where does the company see the most competition? And what is it doing?
All right, so company sees the most competition also in the media segment in Poland, as this market is highly penetrated with the bigger media groups operating in there, and company protects itself through bigger data collection. It has many sources of data, not only the media group, so it can target the potential recipients with advertisement better, having the data about their travel destination, about their creditworthiness. So here WP has a competitive advantage over its media competitors. Also in the travel segment, company established very large base of relations with other intermediaries in the travel. So they are selling trips of other travel agencies, and they have a diversified portfolio of those partners, around 180 partners there. In the smaller segments like consumer finance and other, there is bigger threat for the competition, as also WP is much smaller in those segments than in the media and travel.
I would like also to add from the perspective from the M&A. As you have seen already, the data on customers is extremely important for Wirtualna Polska, as it directly corresponds to the revenue that is potentially could be added to the whole group. As all of the companies' businesses are interlinked with each another by the data cycle and data rotation systems, we could see that the company is extremely active in terms of M&A. In comparison to its local peers in Poland, it has the biggest amount of M&A activity in latest 6 years. With 20 deals made in this time, the company has acquired not only the businesses, the local businesses that provide the similar spectrum of services and solutions, but by the result of that, it also provided the additions to the number of real users. This is a risk-free type of acquisition of third-party data that Wirtualna Polska is focusing on. In addition to that, you could see that they are trying to fight with its Polish peers by acquiring companies abroad, which also brings them another potential in terms of number of real users in Europe, which the other companies in Poland are not doing at the moment to this extent.
Thank you for the presentation. I have 2 questions. What are the key metrics that the company is looking for evaluating M&A opportunities, and what are the potential markets to follow M&A opportunities going forward, in your opinion, and why? And my second question is, why do you think such upside potential is missed by the markets? What do they not see or undervalue?
I will be happy to answer this question. So in terms of future potential for strategy in M&A, we see from the CEO statements, from management board statements, that the company is planning to acquire more companies in the future. In the past, as I said, 20 companies acquired is worthy of a good private equity funds, is almost a really good result for that. What is extremely important in terms of M&A strategy, of course, as you can see, the company added revenue and EBITDA to its financial statements. However, what is more important is the future potential of business growth and interlinking, cross-selling the businesses and solutions to another customers that are not yet a part of Wirtualna Polska business solutions. You could see that for the future development strategy, internet users potential is extremely important. It was the same in the last few years by the acquisition of MediaPop, which consists of few internet services, internet content providers, which gave the company additional 12 million real users in Poland by the acquisition of not only that, but Yastrząb Post and all the smaller content providers that will help with the data cannibalization in the future. Data cannibalization is currently, to be honest, a kind of a problem, as we are currently reaching the cap of number of users in Poland. If we reach this cap too fast, we could face a slowdown in revenue generation process. That is exactly why the company is aware that it should focus on geographical expansion, as then the natural cap of number of real users is potentially going to expand.
I can refer to the second part of the question about the current undervalued by the market. So when we talk about Wirtualna Polska, we are talking about the 3 billion PLN market cap company. The trading on the company is not heavy. It's overall daily, there are less transactions, and the complexity of the business also doesn't help with that, with synergies between the segments, with very different subsidiaries. It's hard to see the ongoing potential of this company.
I would like to get back, judges, to the final part of the first question. You said something about the potential M&A targets in the future. Of course, we are wondering about what could be the next steps, not only in terms of acquisition in Poland, but also abroad. We see some potential very similar businesses that could generate a substantial amount of number of real users, and at the same time, business across outside Poland. One of them could be Money.hu and Ingatland.com, which are placed in Hungary, which are placed in also have some businesses in the CEE. They have very similar similar businesses to our consumer finance part of the business. Acquisition of this could improve our data acquisition, and in addition to that, we see a potential target, Auglio, which is a CE-based startup, which same as Samito SA or Business Click, two companies that Wirtualna Polska already acquired that are based in the marketing automation business. This Auglio startup has a very similar AI-oriented marketing automation business.
Thank you. One more question for me. How exactly did you quantify your bull and bear case scenarios? For example, higher adoption of AI. How exactly did you come up with the numbers and in your model?
So bull case and bear case scenario are made with certain assumptions. For example, we took at the historical data. The company had different periods. Like, for example, the COVID period is a good example, and we tried to calculate our bear case scenario on the basis of the COVID period, when something bad happening for company, and there is a slight decrease of the revenue, but also company is, in this case, it's not a big decrease, as company has this diversification between the segments, and the revenue from different segments compensate for potential losses. And in terms of AI in bull case and bear case scenario, in bear case scenario we didn't include, we stated that it will stay the same, basically it won't have any big influence, but in the bull case we made the assumption of this influence, as we haven't seen in the market the real examples yet. So we see that the AI is big potential for the company like this. They can produce audiobooks via AI, they can produce articles, they can improve their data analysis, So we add slightly higher, as you can see, terminal EBITDA margin.
Time. Thank you, Kosminsky University. At this
Thank
time,
you.
the judges will take a few moments to collect their thoughts and make notes before the next university is brought in.
Thank you very much.
Thank you.
Okay, can you see the slides?
Yes. Please stay muted unless you are speaking. I will start time as soon as a member of your team speaks their first word. You will receive a 1-minute warning and time will end precisely at 10 minutes. Please feel free to begin.
From essential medical devices to high-performance vehicles. What's the link? They all use filters from GVS, an Italian-based company serving the global filtration market in 3 segments: healthcare, mobility, and safety. I'm Renata from University of Naples Federico II, and we are issuing coverage on GVS with a hold recommendation and a year-end target price of 6.42 euros per share, a 5.25% upside on current price. Our hold recommendation is based on 2 pillars. First, we do identify favorable industry trends. However, the company is not always positioned to fully ride them. Aging population and workplace safety push the industry forward, whereas fierce competition constrains the company's growth. And second, GVS is successful in M&A, but now the high leverage limits further expansion. Recent acquisitions have generated commercial and cost synergies, but also left a heavy financial burden, which is now the main challenge. We will now introduce you to GVS and explain why we believe its value is currently reflected in the stock price. Founded in 1979 and currently managed by the Scagliarini family, GVS transformed itself from a small facility to a global manufacturer of the filtration industry. Its products stand for their premium quality and zero defection in compliance with the market's strict regulation. During the pandemic, the company reached outstanding margins thanks to the sale of disposable face masks. However, it is now positioned in line with its industrial peers and well below medtech companies. The offering reaches pharmaceutical companies and OEMs through the B2B channel, whereas in B2C, products are directed to final customers mainly through online distributors. The company has a global outreach sustained by its M&A in market niches. 45% of sales come from the US, followed by Europe and Asia. Michele will now describe you the first pillar of our investment thesis.
Almost 70% of revenues come from the healthcare filtration market, characterized by high barriers to entry. This market niche is defined by low cyclicality and high resilience, providing GVS with constant cash flow contribution and stable margins. However, the company only partially exploits these positive trends because of, first, the competitive arena. GVS faces global players with a wider range of products, spanning from pharmaceuticals to filtering components. Therefore, competitors dominate the niche by leveraging on know-how, reputation, and trusted relation with clients they build in the broader medical sector. And second, the expansion towards B2C. Healthcare is a B2B division, but company guidelines promote a future shift towards B2C. Is it feasible? We don't think so. In fact, B2B offer is mostly directed to major competitors like Cytiva, Sartorius, and Merck. Therefore, we rule out any shift towards B2C to prevent GVS from revenue losses and intensified competition. Moving to energy mobility, it offers filters employed in vehicles. This industry is in continuous evolution and currently shaped by e-mobility. Despite this favorable trend, the division is reducing its contribution to GVS top line year by year, and today it attains a modest 16%. We expect this deceleration to further continue based upon 3 main factors. First, we do not foresee further investment in the automotive industry because GVS focus is the transition to medtech and catching growth opportunity in the safety industry. Second, facing tough competition, the company struggles to increase prices, while it has shown a good degree of pricing power in the safety division. And third, the e-mobility trend seems to be less attractive for the company, since electric vehicles require a much lower amount of filters, only partially offset by a higher price. Now Martina will guide you into the third division.
Health and Safety Division provides masks and respiratory devices. Its contribution has remarkably increased during the pandemic, with a 9-fold increase in revenues from 40 million euros to over 130 million in 2020. Despite the division currently holds a limited role within the company, we expect it will become more relevant in the future. GVS is well positioned to address the rising demand, thanks to, first, the top-notch product offering in terms of quality, design, price convenience, and reusability. Second, the recent RPB acquisition that enriched GVS portfolio with the best-in-class products and promoted cross-selling synergies. Moving to the second pillar of our investment thesis, GVS heavily relies on M&A to generate additional value. The company, in fact, prefers inorganic growth rather than investment in R&D to penetrate in adjacent niches and to enrich its portfolio, avoiding the long times for product development. The ability to identify and integrate targets allows the company to exploit both revenue synergies and cost synergies. Nonetheless, all those benefits came at a cost. To finance recent acquisitions, the company increased its net financial position from 100 million euros at the end of 2021 to 400 million in June 2022. This, together with a lower than expected EBITDA, caused the covenant breach. Right after, the CEO and the main shareholder, Massimo Scagliarini, granted a loan to mitigate this distress, which confirms his skin in the game. We believe that the excessive level of debt imposes the priority of deleveraging in the near future, which impedes the company from further inorganic investment. However, M&A is a core part of GVS business model. Therefore, we assume acquisitions to restart as soon as the company will have a viable capital structure and adequate firepower. Now, Gaetano will show our valuation.
To forecast revenues, we first look at the global filtration market, which we divide in three segments: healthcare, mobility, and safety. Then, by combining our estimates of the industry with GVS positioning in each end market, we assess the top line growth. As a result, we forecast a 5.8% revenue CAGR. Moving on to margins, GVS exceptional results of the pandemic were followed by a strong decline in 2022. However, the company is now recovering with a 22.3% EBITDA margin, and we expect it to reach 26% in 2 years. This value is 90 basis points lower than the pre-pandemic level targeted by the company due to competitive positioning and high leverage. Given these assumptions, we build a 3-stages DCF model to value the company, using an expected 6% free cash flow CAGR, an 8.25% average WACC, and a 2.5% terminal growth. We derive a target price of 6.42 euros and a hold recommendation for GVS. We perform several robustness checks on our model. Monte Carlo simulation, sensitivity, and tornado analysis all reinforce our recommendation. In addition, only to support our DCF, we carry out a relative valuation to get additional insights from the market. We start by identifying peers from the global filtration market, spanning across medtech and industrial companies. We first assign a different score to each company that reflects the comparability with GVS, assessed on both quantitative and qualitative factors. And then we derive a final weight according to GVS revenues breakdown. Using EV/EBITDA EBITDA and PE multiples, we derive a price of 6.6 and 6.1 euros respectively, which reinforce our hold recommendation. Now, Giacomo will guide you through risks and corporate standards.
Our analysis takes into account the risks that could affect our investment thesis. We consider both the likelihood and the impact of each risk on our target price in the worst-case scenario. Moving to ESG assessment, we develop a scoring model, taking as reference company statement and Refinitiv workspace. We give GVS a double B rating, resulting from a comparative analysis of the 3 ESG pillars, revealing underperformance in the environmental pillar, stemming from the current levels of energy consumption and CO2 emission higher than its peers, despite the large use of renewable energy sources. Moving to the social pillar, GVS falls behind its peers. While boasting gender equality in the workforce structure and aligning on the salary gap, the group shows high employee turnover and injury rate. This leaves room for improvement in staff retention and safety. Finally, let's dive into the governance. It is marked by the prominent presence of the Scagliarini family, controlling over 70% of the voting rights and holding 3 positions in the board of directors. The dual role of Mrs. Scagliarini, CEO and main shareholder, raises some concerns about the management of the company. However, under his leadership, GVS has grown substantially, diversifying its portfolio.
In conclusion, GVS is a small yet dynamic player of the filtration industry, riding positive market trends and catching opportunities to expand. However, suboptimal positioning, tough competition, and high leverage due to recent M&A choices limit potential growth opportunities. Therefore, we start our coverage by recommending a hold. GVS, navigating challenges, holding value. And now we are ready to answer to your questions.
Thank you. Judges, at this time, please turn on your video. Please stay muted unless you are speaking. I will start time as soon as a judge utters the first word. The Q&A period will last at least 10 minutes. If it is still going after 10 minutes, we will continue for up to 15 minutes total. If any time after 10 minutes, the judges have no remaining questions, we will end the Q&A period before 15 minutes. Please feel free to begin.
Thank you very much, team, for your presentation. Just if you go back to the covenant breach, how exactly does the company plan to have a tighter control on the working capital and not to have the same situation with the covenant breach repeat in the future?
Okay, sure. So actually, to add more color on the covenant breach, it happened in the first half of 2022 due to the high leverage that the company has decided to take on to finance recent acquisitions. About instead the management of the working capital, actually the company has suffered this issue in 2022. This is due to the client stocking issue that characterized all the market. Also, for instance, Sartorius, there is a huge competitor of GVS, has experienced the same issue. The company, so in March 2023, has achieved the maximum level of inventory, with in March 2023, 150 million euros of inventory. But then at the end of the year, with the fiscal year 23 results, they showed a 90 million euros inventory. So they already reduced this value. Moreover, most of products that GVS sells are set to expire in 2024. So actually, the level of inventory will reduce because these clients will need to buy again the products.
So thank you for the presentation. What do you think about how poor social performance will affect companies' operations and financials going forward?
Okay, I can take this one. Thank you. First of all, in our view, our proprietary framework of the ESG affects our overall analysis of the company on two sides. First, the first one is about the investor side, because the low grade BB rating mainly can make the stock less appealing for investors and funds. Instead, about the key financials of the company, there are some key metrics that affect them. In particular, for the social pillar, there is the turnover of employees that is very high with respect to its competitors for the last 3 years. This metric, impacted the cost of the company, especially the personal expenses and the cost for recruitment. However, it is important to note that this high value are not a structural problem of the company. They are due to recent workforce reorganization of the company due to recent acquisitions that they made. For example, they are moving employees from US to the new plants in Mexico.
How did your ESG analysis inform your investment decision or your valuation?
Okay, yes. Our result for GVS is a 6 out of 10 that corresponds to a BB. As we can see from the slide, the ESG rating for GVS for the last 3 years has been lower than the industry peers. This obviously makes the stock less appealing for investors, and this could decrease the interest of investors toward the stock.
In addition to this, also the family structure business that affects GVS impacted on our valuation. And in fact, such a high concentration of decision power with the Scagliarini family holding over 70% of the voting rights and holding 3 out of 9 positions in the board of directors clearly raises concerns among investors, and especially with referring to the risk for minority shareholders protection. At the same time, we need to recognize that the Scagliarini family, thanks to its long-lasting presence and profound knowledge of the business, has allowed the company to grow substantially since its foundation. So it is always a balance between positive and negative aspects.
Did you incorporate this into your valuation?
yes, we take into account such a family-run business because on the one hand, this concentration of decision power raises the skepticism among investors. So on the market, the stock may be not so appealing. But on the other hand, on several occasions in the past, the family has shown its full commitment to the group and has allowed it to capture important growth opportunities. A tangible example has been the pandemic, when the company was able to shift the production towards the disposable face mask that represented at the time the urgent need.
But how did you reflect this in your valuation work?
Yes, we investigated this risk on our analysis. If you can go to the slide about the loss of key figure risk, that is related to the departure of one of the key members, in particular of one of the three family members of the board. And we analyzed this with our worst case scenario analysis, in which we, first of all, we identify a variable that best proxies the risk. In the loss of key figures, in our view, the best proxy is the weighted average cost of capital. And then we run several simulations with different shocks, and then we take the 10 percentile of the distribution, and we define this as the worst case scenario. And in the worst case scenario, the departure of one of the family members from the board could have a huge impact on target price, especially in particular a decrease of 20% on target price, and this would change our recommendation to a sell.
Moreover, we also, just an add-on, we also incorporated the governance into our valuation with the deleveraging priority. So in 2022, they breached the covenant, and also in 2022, there was the departure of the CFO. So the company then, since then, has started a more disciplined behavior also in terms of disclosure to the market. And so this is another way in which we incorporate this in our valuation.
Thank you.
Thank you. Apart from the 90 bips difference with the management target regarding the margins, how else does your model different from the company guidance and from the consensus?
Okay, I can take this one. As you can see, our estimates for the future are pretty in line with both consensus and also with company guidance. As you can see, our forecast for fiscal year 23 are the same one of the consensus. We just depart from consensus and from the company guidance starting from 2026 onwards. And this is because we use a more cautiousness approach regarding clearly the future revenues of the company, but at the same time also regarding the speed of deleveraging itself. We focus the possibility of the company in deleveraging, but it's also could be affected by several events.
And moreover, actually, we are assuming a prudent approach also on the side of cost synergies. So the company with these two big acquisitions that also caused the covenant breach wants to extract synergies, as my colleague said, in workforce organization. So they are shifting employees from North America to Mexico, and also plant optimization. For instance, with the acquisition in China, they're merging two plants. In our vision, we have to say that we are a little bit more cautious about the speed at which the company will be able to extract all these synergies, because we think it will take time.
Yes, let's say that we are quite prudent in terms of the company's capability to fully exploit all those positive trends that we underline in our first pillar. So our prudence arises from this suboptimal positioning that characterize the company across the end markets through which GVS operates.
Okay, I see you are very conservative and prudent in your evaluation, but let's say you would become a CEO of the company tomorrow and you have the entire power in your hands. What would be the first thing you would do?
Okay, so first of all, we will, in our opinion, it will be important to shift the product mix towards the safety division that is the most profitable one. The company is partially doing it, but is still quite exposed to the mobility segment. It is the less appealing one. So first of all, we would like to focus more on the safety division. Then there is some ESG concern, as the company is not disclosing any target for consumption. So on the environmental side, consumption reduction, there are no targets. So we would like also to increase possibly this score that will allow the company to be more appealing also to ESG investors.
Moreover, the company main strategy is the M&A strategies, but as we underline in our presentation, the company cannot perform the M&A in the next years due to the the leveraging priority. So we believe that one strategy that the company can pursue in the next years in order to keep up with the competitors can be and further investment in R&D. Indeed, the company currently invests in R&D at 6% of revenues, that is below the investment in R&D on medtech companies that are the competitors of the healthcare market.
Another question from my side. Do you think a rights issue capital increase may be on the agenda in order to reduce debt-related stress on the financials?
Sorry, could you rephrase, please?
Do you think a rights issue capital increase may be on the agenda in order to reduce debt-related stress on the financials?
So about capital increase. So actually, we do not think this will be a possibility because in the company, as we said, has pursued 3 companies between 2021 and 2022. So the main focus now for the company is extracting synergies, integrating these companies. Historically, the acquisition strategy was a bolt-on strategy. So the company was acquiring small businesses that were easy to integrate. But now with these 3 big acquisitions, mostly the Emotronic and RPB acquisition, the priority is extracting the synergies and create value from these acquisitions.
Okay, in addition to this, we also had a meeting with the investor relator of Q.P.S.C, and they confirmed that they are not ready yet to face a capital increase, so issue new equity on the market.
What is your terminal growth assumption?
Okay, so our terminal growth is 2.5. We think this number allows to reflect, first of all, the global economy projections, so the long-run growth of the GDP. But then we are adjusting for the suboptimal positioning, our cautiousness in our equity story. So basically, this number, for instance, checking also terminal growth rates used by investment banks that cover this company are around 3%. So we decided also on this metric to be quite a little bit more prudent.
Is this a nominal figure or a real figure?
Okay, so we have a 2.5 that is based on a 2% target from central bank, both Federal Reserve and the European Central Bank, and then we have a plus 0.5% that clearly affect the real growth of the economy.
So the 2.5 is a real figure then?
Yes, yes, it is.
Yes, it is.
Thank you. I would like to continue with the next question on the margin. What are the main drivers of the margin development going forward? What is going to drive the margin?
Thank you. This is a key point in our analysis. So margins will be driven by 2 catalysts: revenue synergies and cost synergies. But it's important to outline first that the company is not disclosing any metric, any margin about the divisions. So what we are projecting here is the aggregate margin of Q.P.S.C. On the revenue side, the company will be positively affected by a higher exposure to the healthcare market and personal safety market. They are the most profitable one. This ranking is derived by looking at margins of the acquired companies. That is the only thing that the company is currently disclosing. On the cost side instead, the cost synergies will allow to improve the efficiency and so to increase margins, in particular, reorganizing the workforce, merging plants, so saturating the production of plants will allow to increase the margins. That will increase up to a level of around 28% that is in line with the pre-pandemic level that the company achieved.
Thank you. Then I'm continuing. On slide 33, you're showing a scenario analysis with 2 scenarios, bulls and bear. My question is as follows. What are the valuation kind of impacts of those 2 scenarios?
Okay, I'm happy to take this question. So let's start with the bull case scenario in which we review our valuation from an hold up to a buy, in which Q.P.S.C goes under a complete transition towards the medtech industry. What the company does is clearly undertaking a more aggressive approach regarding R&D to overcome its suboptimal positioning. As you can see in the slide, our final target price will be around 8, which transform our old recommendation from a 5.25% upside to a strong upside. But let me say that we deem it to be not so much realistic because the company needs to reshuffle its business model.
So to wrap up, the effect on our valuation in this bull case is an increase on the exposure on the healthcare market. So the company a shift towards the pure medtech.
Time. Thank you, University of Naples, Federico II. At this time, the judges will take a few moments to collect their thoughts and make notes before the next university is brought in. Welcome, University of Jordan. At this time, please launch your presentation and make sure it is working properly. Ali, could you please turn your video off? Okay, please stay muted unless you are speaking. I will start time as soon as a member of your team speaks their first word. You will receive a 1-minute warning and time will end precisely at 10 minutes. Please feel free to begin.
We issue a buy recommendation for MOBEDCO stock with the target price 2.61 GDs, indicating 18.74% upside the current price, which is 2.2 GDs. We are the University of Jordan team presenting our analysis for MOBEDCO. MOBEDCO was established in 1991 and in 2005 became publicly listed in Amman Stock Exchange. The company's product categories divided into pesticides product and veterinary drugs, with the plans to enter the vaccines market. Regarding MOBEDCO's subsidiaries and affiliates, Delta Saudi is the only major contributor to MOBEDCO's profitability, with 44% contribution to profit before tax in 2022, noting that MOBEDCO owns 55% of Delta Saudi. And 9% of MOBEDCO's shareholders are institutional investors, with 35% as of free float shares, and 25% of the company's shares owned by individuals in the board of directors. As for company sales in 2022, 76% of the company's sales are foreign sales and distributed to more than 30 countries.
Besides the results of our valuation, our buy recommendation is also encouraged by MOBEDCO's operation in prospering markets, their diversified collection of products, and their promising profitability. MOBEDCO's product lines are direct inputs in the food and agriculture markets. This represents a sound choice of products to offer because these markets are expected to grow all over the world. MOBEDCO delivers their products to many countries in several regions on a global scale. In its industry, MOBEDCO is the second largest Jordanian company in terms of product number, with more than 300 products in their collection. Their newest addition, the vaccines line, exhibits pleasant financials. These figures were extracted from a feasibility study, which they themselves performed and published for this project. On average, the forecasted gross and net profit margins for MOBEDCO are 34% and 19% respectively. This represents a stable growth in profits from the present time. Improving margins are a great incentive for investment. The growing world population, decreasing land area on which farming is possible, and the worldwide prevalence of food insecurity drive the demand on food, and therefore demand on agricultural products will go up as well. Additionally, individuals have been worrying more about foodborne diseases, which are the result of consuming meat products from untreated livestock. These worries drive the demand on veterinary healthcare products.
The value of pesticides and veterinary drugs in the international market reached approximately $70 billion and $50 billion respectively. As an example, on the major players in the international market are Bayer and Syngenta. In the local market, pesticides and veterinary drugs value reached 195 million JDs. In Jordan, there are 35 companies that produce pesticides and veterinary drugs. Out of these 35, there are 4 major players: MOBEDCO, VABCO, MEDMAC, and MOBEDCO, noting that MOBEDCO is considered the second largest company after VABCO in terms of distribution and production. By adding the new veterinary vaccines line, MOBEDCO is going to face a strong competition with Jovac, noting that Jovac is the pioneering company in producing veterinary vaccines in the local market. In the local market, the consumer base mainly consists of small farmers. MOBEDCO leverage on many competitive edges, as MOBEDCO is located in Jordan that mediates the MENA region. They do not depend on a particular consumer or supplier, as well as a diversity in production. They produce more than 300 products and distribute it to diverse markets. However, MOBEDCO issues lenient credit policy, long product registration period, and they depend on raw materials from sources outside Jordan and supply chain challenges. Based on Porter's 5 forces analysis, the threat of substitute is high for both pesticides and veterinary drugs markets. However, other threats are relatively low.
MOBEDCO's environmental stewardship is satisfactory, and this can be seen in their use of solar power, which annually reduces 1,460 tons of carbon dioxide in emissions. Most importantly, MOBEDCO was seen participating in the MED3 test conducted by SwitchMed. This really shows how keen they are on further improving their environmental practices. MOBEDCO embraces social responsibility through actions such as providing annual cash donations, training university students, and providing training for their own employees as well. However, the fact that they only concentrate their investments in companies of similar economic activity exclusively is concerning. MOBEDCO's board consists of 9 male members with diverse educational backgrounds. Even though MOBEDCO's governance aspect is the most sound in their ESG, it's important for us to emphasize that in 2 of the 4 committees formed from the board of directors, we found a few problems. As we see here, the nomination and remuneration committee includes 2 non-independent members. The governance committee includes 3 non-independent members and an executive. Both committees are chaired by non-independent members. These are clear violations of corporate governance instructions as told by the Jordanian Securities Commission. Here we present the ESG scores for the separate pillars, noting that the scores for the environmental and social responsibilities are derived using the MSCI ESG scoring framework.
MOBEDCO's revenues are driven by the increasing demand on agricultural products. This demand is driven by factors mentioned earlier. Due to delays in shipping, we expect modest growth in 2024 revenues. However, in 2026 and beyond, the company is projected to have strong growth in sales as the new veterinary vaccines line will start operating then. Raw material accounts for 81% of total cost of goods sold. We expect higher costs of raw material, freight, and insurance in 2024 as a consequence to the recent Red Sea blockade, which led to difficulties in shipping goods. In 2026 and beyond, we expect higher production costs and registration fees for vaccines, accompanied by higher growth in sales. Compared to its peers, MOBEDCO possesses significantly higher net profit margin, as the average for peers was 15% when MOBEDCO had the 20% margin. Also, comparing MOBEDCO's return on equity to the average for peers, we're going to find that they were almost identical in 2022. However, the new factory expansion and the higher dependence on equity are going to drive MOBEDCO's return on equity from 14% to 12.5% through our forecasted period. The company holds a great liquidity position. It is able to cover 60% of its current obligations from cash only. However, we should not neglect the long cash conversion cycle MOBEDCO has, which limits the use of funds in other business aspects and increases the risk of bad debt. The company has maintained stable dividend payout ratio of almost 30%. Also, it has maintained constant dividends per share with expectations to increase with the new expansion.
We used 3 valuation methods to reach our target price of 2.61. Different weights were assigned to each method. 70% for the DCF, mainly to reflect the firm's new expansion plan and its intrinsic value. 20% for the multiple is driven by the lack of local comparable peers, because in this industry, MOBEDCO is the only listed company in Jordan, and the international peers and the regional peers have different product line. 10% for the DDM, because the firm doesn't pay all its earnings as dividend, with only 30% average payout ratio. We run a sensitivity analysis in terms of WACC and terminal growth rate to observe that changing on the DCF price result in a price range from 2.22 to 3.64. To assess how MOBEDCO price would be affected by uncertainty, we perform a Monte Carlo simulation, and 94% of all outcomes confirm our buy recommendation. We did a stress testing on MOBEDCO feasibility study that was published for the new vaccine project, and by reflecting the most optimistic figures, the overall valuation price reached 2.77. However, if the project failed to generate any profit, the overall valuation price will decrease to 2.23.
We have identified several risks MOBEDCO may face, with the 3 key risks significantly impacting the company: credit risk, logistic risk, and registration risk. As a result of Red Sea blockade, many companies had to reroute their ships away from the Suez Canal and Bab el-Mandeb checkpoint by taking the longer road around the Cape of Good Hope to reach Asia and Europe. We reflect that in our valuation by increasing the cost of goods sold 4% and decreasing the sales growth rate 2.5% in 2024. Registering pesticide in Jordan is a year-long process. Compared with other countries, which needs only 8 months on average, MOBEDCO can mitigate this risk by taking the privilege of having a subsidiary in Saudi Arabia, which pesticide registration requires only 22 working days. In 2021, MOBEDCO started to write off, with more than 1 million write-offs only in that year. We were conservative in our valuation, taking into consideration this risk. To close, we set our buy recommendation based on our analysis for MOBEDCO, resulting in target price 2.61 GDs. Thank you for your listening, and now we open it up to your questions.
Thank you. Judges, at this time, please turn on your video. Please stay muted unless you are speaking. I will start time as soon as a judge speaks their first word. The Q&A period will be at least 10 minutes. If it is still going after 10 minutes, we will continue for up to 15 minutes total. If any time after 10 minutes the judges have no remaining questions, we will end the Q&A period before 15 minutes. Feel free to begin.
Thank you very much for your presentation. How did your ESG analysis inform your investment decisions? Or let's put it differently, how did you reflect your ESG analysis evaluation?
I may take this question. Okay, so what we did here is that we considered an additional risk premium, which includes 0.75% to account for any weaknesses in the environmental and social pillars. Yeah, that's about it. Would you like me to elaborate more?
No, it's good. And how did you reflect the governance item you flagged in your analysis?
Well, we reflected only the environmental and social parts because the governance performance for this company was quite average. And the real weaknesses were noticed in the environmental and social aspects specifically.
Thank you.
Would you say that 3% risk premium is a justified premium for such a low free float of 35%?
First of all, the 3% risk premium reflect certain things like liquidity in the market, the political issues surrounding the area, and the ESG. The 3% about the free float. The free float is in Amman Stock Exchange is above average because Amman Stock Exchange and Jordan doesn't have a highly liquid market, which indicating a high free float. So the free float in this company is quite average.
Okay, and I will continue with this question regarding the new vaccine line. Should this new product line, which you expect in your model beyond 2026, let's say fail, what will be the probability of that and the impact on growth and valuation?
We did a scenario analysis. The first scenario, the blue sky and the gray sky, we called them. The gray sky, which indicate the bearish case. And our financial model, we assume that the firm will not generate any profit from this new project and will incur all the cost from the project, which almost 10 million and higher, as they disclosed in their case study. So in the gray sky scenario, we assume there's no profit from the new vaccine project, but from the company operation, there's still profit. But we assume the profit from the new project will not generate anything and incur all the cost. So the overall valuation, as we see, the DCF will decrease to 2.29, and the overall valuation price will to be hold, not buy.
Thank you for the presentation. How come net profit margin for this company is increasing while its peers is decreasing over the last 3 years?
Thank you for your question. So MOBEDCO has mainly 3 things that contribute to its stable net profit margin or high net profit margin. The first one is that MOBEDCO has a relatively low and stable cost of goods sold margin compared to its peers. Most of its cost of goods sold is raw material, therefore it can take the advantage of not relying on more than one supplier and basically just change its suppliers if any the cost of raw material changed. This helps the company maintain its gross margin, therefore its net profit margin. The second thing is that MOBEDCO is in Jordan. Jordan has a strategic location which is centralized in the Middle East. It's centralized in the Middle East. Therefore, MOBEDCO has stable freight costs. Finally, MOBEDCO operates in the qualified industrial zone, which has fixed tax rate of 5%, which also contributes to its stable net profit margin and high net profit margin.
Does the company hedge any of the raw materials?
Could you please repeat your question?
Does the company hedge any of its raw materials? The cost of raw materials?
In this industry, in the industry that MOBEDCO operates in, it is normal to have high costs of raw material. And since MOBEDCO does not rely on a specific supplier, so it has the options or different alternatives to choose from different suppliers with different prices of raw material.
May I add one point? You asked if there is any hedging strategy for the costs. Well, we did not witness this, and such practices are not really common in this industry. In the Middle East region specifically, we don't really see this. This is not common.
If we go to slide 26, valuation, can you please explain to me why you chose DCF and DDM and why you chose those weights?
We choose this three valuation method because we give the most weight for the DCF to reflect the firm expansion plans, and we didn't give any zero weight to the DDM because the company have a stable dividend policy, and it gives dividend every year. So we have to include the DDM in this method.
Okay, but those are both discounted cash flow methods. In an ideal world, this should lead to the same result because one is free cash flow to equities and the other one is free cash flow to the firm. Now, why is the difference in target price almost or more than 10 times bigger for the DCF?
The DCF mainly depend on the free cash flow to the firm. The firm has a lot of BBE and capital expenditure, and the net income relatively low, opposite to the assets and the things that going in. Can you open the appendix for the DCF? Wait. No, discount cash flow. When we calculate the DCF, we include the non-cash expense, we include the capital expenditure, so the number is relatively higher, and we discounted by the whole work, not only the cost of capital. But when we calculate the DDM, we only use the net income, and after deducting the minority interest, because this firm has an affiliate in Saudi Arabia, and we must and not disclose a separate financial statement. It disclose a consulted financial statement. So maybe this is the reason for the variation between the methods, and this is why multiples method has been deducted on also, and this is why we use in the valuation not only one method. We use three methods to be sure of what value the firm is.
Well, if we go to the multiples now, you took 3 different multiples. Why did you choose also price to book?
We use this three ratio because there's the most common and the most reflecting for the firm value, and to compare the firm between each other. We give 80% for the EV to EBITDA to remove the effect from different accounting method, like depreciation between the periods, and to make the comparable more comparable.
But you did not answer to my question, why you use price to book?
we used this the three ratio that was the most common. We saw another ratios, but we thought that this is the three most sounded, and because price to book and price to earning reflect equity, so we choose to these three ratios.
Thank you.
If we go to slide 18 about revenues, may you guide me how exactly you modeled each of the growth drivers into your final revenue growth projections?
No, not this one. The one which includes the world the big growth rate in the population. No, appendix. Okay, so factors we took into consideration were so the growth rate that we resulted in took into consideration the growth in the world population and the growth in the population of the MENA region, and we gave a heavy weight to the proxy, which is for the world population rate, taking into consideration that 75% of MOBEDCO sales are international.
So I have a follow-up question. How can you come up with 84 out of 100 as a governance score for such a company with non-independent board members and board members having almost only 25% of all shares?
Okay, I'm going to take this question. Okay, so this MOBEDCO's governance aspect deserved a score of 84 because well, I wanted to take into consideration that what I presented to you was pretty much their worst breaches. However, everything else concerning, for example, the composition of the board and their duties and the two other committees, which are the risk management committee and the audit committee, everything was fine. Everything was absolutely acceptable. So this is what really justifies our score.
What is a distinguishing factor for this company compared to the peers that you have mentioned in your presentation?
Sorry, could you repeat your question?
What is a distinguishing factor for this company compared to the peers that you have mentioned in your presentation?
Okay, so MOBEDCO has a strategic location in Jordan, and they do not depend on a particular supplier or consumer for their raw materials. Also, they have diversity in production. They have a lot of product lines. So they have more than 300 products. And their market diversity, they distribute their products to diverse export markets, and they are thinking of expanding their markets in the future.
Okay. And with over 20% of upside that you're projecting, what do you think the market doesn't see that you see?
I'm going to take this question because MOBEDCO is thinking about expanding in the future. An example on that is their veterinary vaccines project in the future that it's going hopefully to generate profits for them. And they expand in their product lines. So this may be an edge for their peers in the local market.
Please add a few points. Something that's really standing out about their expansion project.
Thank you, University of Jordan. At this time, the judges will take a few moments to collect their thoughts and make notes before the next university is brought in. Welcome, University of Lagos. At this time, please launch your presentation and make sure it is working properly. Please stay muted unless you are speaking. I will start time as soon as a member of your team speaks their first word. You will receive a 1-minute warning and time will end precisely at 10 minutes. Please feel free to begin.
In a world where business dynamics shifts as rapid as colors on a palette, Chemical and Allied Products Q.P.S.C is an epitome of innovation and resilience. My name is Pelumi, and with me are Aisha, Peace, and Tomiwa, and we will be issuing a buy recommendation with a 12-month target price of 34 Naira and 46 Kobo, representing a 65% upside on its last close. Do stay with us as we reveal CAP's true proposition.
CAP
Founded in 1957 with headquarters in Lagos, Nigeria, it is a subsidiary of USC of Nigeria PLC. It produces and distributes quality paints and chemical products to a wide range of clientele. Positioned in the premium segment, CAP distributes Dulux in partnership with AkzoNobel, operates in the standard segments with Santex and Caplux paints, and distributes MPL paints in partnership with MPL Group. With 73% sourced locally and the rest internationally, the raw materials undergo a granular production process to yield top-notch products and are distributed through a B2B2C model. As part of the company's strategies, it pioneered the concept of color centers in 2005 and it currently has 109 stores. This, in addition to strategic partnerships, including the 2021 merger with Portland Paint, has contributed to CAP's market leadership, attaining 23 billion naira in 2023 revenues, a 24% increase from 2022. We expect CAP to sustain its market leadership in Nigeria and extend its leadership into West and Central Africa in the near term. Aisha, walk us through the industry.
Despite the economic challenges precipitated by Russian invasion of Ukraine and the Israel-Hamas tension, the global economy has remained resilient, with growth estimated at 3.1% and a moderated inflation rate of 6.9% by 2023. Factors like declining inflation, a resilient US economy, and fiscal support in China are expected to strengthen the global economy. The Nigerian economy faced its share of challenges, with tough political transition and stringent macroeconomic reforms. Irrespective, growth is expected at 2.8%, reaching 3.1% by 2025. Our team notices the rising pressure in the goods, labor, debt, and foreign exchange markets as a result of these reforms. Hence, we forecast stringent macroeconomic conditions in 2024. The global paint market is $177 billion in revenue in 2023 and is forecasted to grow by a CAGR of 4.6% by 2032. This is supported by the thriving building, automotive, and construction sector in Asia, Europe, and Africa. The Nigerian paint market generated 120 billion naira in revenue in 2023, with about 20% attributable to CAP. This industry is expected to grow at a CAGR 4.1% by 2028, supported by high urbanization and construction activity. As a fragmented industry, the unorganized sector accounts for about 88% of the market. More so, the market is raw material dependent, with about 80% of raw material sourced internationally. Market analysis shows that CAP stands out with distinct product quality. CAP's market strength positions it to benefit from infrastructural revivals by the government. However, high cost of raw material poses a threat. Now, Tomiwa, what are the ESG considerations?
After a comprehensive analysis of CAP's sustainability practices, we assigned a global score of 67.13% against an industry average of 55.25%. Environmentally, CAP scored 52.5%, focusing on VOC impact, waste management, amongst others. Notably, CAP leads in innovation by producing lead-free paint and conforming to global standards. However, despite aiming for net zero emissions by 2050, energy consumed by the company have spiked remarkably. Also, CAP has an effluent treatment plant, but wastewater treatment levels have decreased over the years. Socially, CAP scored 76.25%, demonstrating appreciable compliance with human rights, labor standards, amongst others. In terms of governance, CAP scored 77.5%, highlighting a strong and diverse board led by Mr. Fola Shokwe Aisimoju, independence of the board and gender diversity. Overall, CAP is an ESG leader, with current environmental audits being carried out by an engaged consultant, indicating the company's commitment to improving its sustainability. Now, P.S.C, walk us through the numbers.
CAP has demonstrated remarkable growth in revenue, recording a CAGR of 25% from 2018 to 2023, growing revenue from 7.6 billion naira to 20.8 billion naira. We expect this positive growth to continue as the forecast revenue to grow at a CAGR of 14% to reach 44 billion naira in 2028. These growths will primarily be driven by the company's increased investment in research and development, its expansion of its retail footprints locally, penetration into regional markets across West and Central Africa, as well as leveraging the continued growth in the Nigerian real estate and construction sectors. Maintaining margins at 40%, CAP has surpassed its industry peers average of 29% over the years. We expect CAP to maintain stable margins at 39% as the company has been able to employ effective foreign exchange risk management and local sourcing strategies. These stable margins, owing with the company's growing revenue, led to an average ROE of 39%. Expect CAP to deliver an ROE of 30% in the coming years. Additionally, the company remains committed to delivering value to its shareholders, maintaining an average payout ratio of 64%, and an average dividend yield of 5.94%. We expect CAPS to deliver a dividend yield of 6.04% in 2024. Operating an inventory-centric asset model structure, CAP has seen a total of 26% of its total asset locked in inventory investments. We expect trend to continue with an average of 24% in the coming years. From our perspective, we believe CAP's capital structure reflects a conservative reliance on equity financing, evident in its modest debt-to-equity ratio of 3% over the past 5 years. We expect leverage levels to remain stable at 2% as the company can generate significant cash flows to finance its future expansion plans. Furthermore, conducted an post-fiscal analysis to assess CAP's risk of bankruptcy and financial stability. With a score of 3.81 in 2023, this poses lower risk of bankruptcy supported by robust cash positions. Now, having seen its M score drop to a negative 6.64 in 2023, this poses improved financial reporting and a lower risk of earnings management. Now, Pelumi, how does it reflect on our valuation?
While technical analysis offers insights into short-term market trends, we are confident that its reliance on historical price data ignores long-term value trends. In painting CAP's true value, we have employed a blended valuation methodology, comprising the ESG adjusted DCF at 40%, the ESG adjusted DDM at 40%, and a relative model at 20%. This resulted to a share price target of 34 Naira and 46 Kobo, representing an upside of 65% on its last close. To this effect, we issue a buy recommendation. We have discounted our free cash flows to the firm using a discrete WACC of 18% and a terminal WACC of 16%. Our beta also considers significant adjustments such as the Bloom adjustment as well as the ESG factor, comparing CAP's ESG efforts against its industry peers. Our terminal value is also termed significant, as it accounts for more than half of the total enterprise value. Now, this necessitated a sensitivity analysis on terminal growth and discount rates, revealing that our worst-case scenario reduces target price by 11%. We have further conducted a Monte Carlo simulation, which reveals that 65% of our prices fall within our buy margin. Now, to support our DCF, we have also conducted a DDM, showing CAP's commitment towards strong dividend payouts. And finally, our relative model uses the NTM EV to EBITDA multiple, showcasing players in the Nigerian and African markets. Our scenario analysis analyzes revenue margins and cash forecasts to reveal bull and bear upsides of 99% and 23% respectively. Now, P.S.C, what risks do CAP's investment returns possess?
Our risk matrix analysis identifies some potential downside risks to CAP's investment returns. Firstly, reliance on AkzoNobel for the license to trade its deluxe trade products poses a risk in our analysis. To mitigate this risk, the company engages efficient relationship management with AkzoNobel. Currently, the company does not disclose its incidental releases of the Scope 1 and Scope 2 CO2 emissions, which could pose regulatory and other reputational risks. However, we rated the company with a favorable ESG factor of 0.735 relative to its peers. This was included in our WACC calculation, thereby reducing cost of capital. To mitigate this risk, the company engages an environmental consultant regularly. Now, having seen its finance directorship role change 3 times in the past 3 years, this could indicate operational risks that could stem from financial inconsistencies and a lack of disclosures. To mitigate this risk, the company engages in robust succession planning strategies for management. Other risks include foreign exchange risk, as well as variable interest period that has seen the SOFR go up by 449 basis points from 2022 to 2023.
How I can recognize and embrace opportunities while others ignore them. Ladies and gentlemen, the University of Lagos stands tall and poised, bringing to you CAP's untapped potential. We will emphasize our buy recommendation as a result of 1, strategic partnerships that drive competitive advantage, 2, is leadership in innovation and ESG considerations, and finally, robust cash flows that drive strong dividend payouts. We have painted CAP to have bold innovation and unwavering commitments. Thank you.
Thank you. Judges, at this time, please turn on your video. Please stay muted unless you are speaking. I will start time as soon as a judge speaks the first word. The Q&A period will be at least 10 minutes. If it is still going after 10 minutes, we will continue for up to 15 minutes total. If any time after 10 minutes, the judges have no remaining questions, we will end the Q&A period before 15 minutes. Please feel free to begin.
Thank you for the presentation. What do you think the market is missing for such a high upside potential?
Sorry, could you retake the question? I couldn't hear it.
What do you think the market is missing for such a high upside potential? So what's the things that you see but the market didn't recognize yet?
For that question. So in our analysis of the industry, we got to understand that the major driver driving CAP is activities in the construction as well as the real estate industry. And this industry is performing relatively well at this period in time. Construction industry is forecasted to grow by a CAGR of 4% till 2026. And then the real estate industry is also driven by high population growth rate as well as the high demand for residential as well as commercial buildings. So this is one of the things we consider in arriving at the upside. Thank you very much.
And in addition to that, this industry positivities as well as stable margins have all been discounted to the present value to reflect that upside. Thank you very much.
In your DCF, you are including a growth rate of 2.7%. Is this a real figure or is this a nominal figure?
Thank you very much for that question. That is a real figure. The growth rate of 2.7%, if we could go to the main slide on ESG adjusted DCF, the growth rate of 2.7% was triangulated from the IMS forecast of GDP growth in Nigeria, which was 3%, and management's forecast, which is the average of Nigeria's growth rate for the past 10 years. This was triangulated to arrive at the growth rate of 2.7%. Thank you.
I would like to dive in your M-score model, which you show on slide 26. May you elaborate, please, what happened in 21-22? Did you check in detail how come we got this manipulator score readings there?
Thank you so much for that question. If you could go to the appendix on M-score. So M-score measures the reliance and the reliability of financial reporting of firms. Now, over the years, we've noticed discrepancies that play out in these industries. And the M-score was carried out to test for financial reliability. Having seen on the back of some of the scandals that have come about in the Aaron and other words in the financial space, we conducted an M-score to test for the reliability of CAP's financial reporting. Now, as you can see, the M-score benchmark is supposed to stand at a -%. But if you could see from 2021, the score posed a significant positive figure that could indicate some discrepancies in financial reporting. But over the years, we've seen an improvement. And as at 2023, we've seen that M-score fall to a -6.64, indicating improved financial reporting and disclosures. Thank you.
Thank you. My question was more, did you look at the numbers, for example, for 2021? Did you dive deeper into asset quality index, for example, or accruals? Did you check that the management didn't inflate their earnings by deferring certain profits or accepting some questionable accounting choices?
All right, thank you so much for that question. So in 2021, this remarkable spike was on the back of a completed merger that saw them merge two firms, which is Polsak and CAP PLC. So that created a varying discrepancies in the figures highlighted below, because the reporting style of the previous accountant from the firm coming forward was a whole lot more different. Like if you take a look at their cash flow statements, you see that some of the reportings, some started with profit before tax, some started with profit after tax. Just these discrepancies was based off the back of the merger that saw two financial firms merging together. But you see the significant improvement once the consolidation was taking place in 2022 and 2023.
Thank you. And do your cash conversion calculations prove the point that you just mentioned?
Yes, if you could go to the slide in ratios analysis in the appendix slide, you see that the rate of the inventory turnover to the receivables and the payables period, there was a fluctuation in 2021, as evident in the cash working cycle. You see that it was coming from on the back of 69 days negative, but moved to stabilize once the merger arrived.
Thank you.
Staying on slide 26, why does the Z-score matter for your investment decision?
Thank you so much for that question. Now, the Z-score is very significant because it seems to highlight the risk of bankruptcy for each firm. This score in particular would increase investor sentiment in a company. Now, having calculated the Z-score, we identify that CAP poses a lower risk of bankruptcy based off its operations and hereby solidifies investors' confidence in this stock. Thank you.
But with a 2% debt to equity ratio, is this relevant or is this not relevant for an equity investor?
All right, thank you very much for that question. We believe this is not relevant in terms of an equity investor because we see that CAP has been able to generate relevant cash flows from its operations to actually carry out its operations and also position it very well in terms of expansion plans for the in the near term. So we believe this is relevant for the investors, as we believe that they can take advantage of this for the near term. Thank you.
Thank you. And in addition to that, if we could move to the slide on valuation summary and rating, you can see that CAP is able to generate sustainable cash. The main slide on valuation summary and rating. CAP is able to generate sustainable cash flows from its cash-centric policies with retail customers, as well as a stringent credit policy with credit customers. So this ability to generate cash places it on a level to have enough cash to finance investment opportunities. So for equity investors, that is relevant. Thank you very much.
So, which markets do you think are right to penetrate outside of Nigeria for future investments? And what are the key metrics that the company will be looking to enter in any of these markets? And how do you think will these investments be financed?
That question. So according to management guidance, CAP is looking to expand into West Africa as well as Central Africa. And then the factors that are contributing to this is because one of those factors is the paint consumption per capita. So paint consumption per capita in this region is about 1 to 2 kilograms as compared to developed countries, which is about 16 to 18 kilograms. So this shows that there is an untapped market for the paint industry in this region. And I'm sure that's one of the reasons why the management is looking to expand into this region. Thank you very much.
In addition to that, on how the company seeks to finance these acquisitions and the expansion into these regions, we believe based off the strong cash position of the company, they're able to take advantage of any opportunities in the short term to move and strategically position themselves in this market.
Out of interest, since you include the technical analysis on slide 28, do you think with all this negative technical momentum for your stock, your investment case and target price is attainable?
So could you take the question again, please?
Sure. Since you're showing the technical analysis and with all this negative technical sentiment that we see on the slide, do you think your investment case and the target price, is it attainable in the time horizon that you're projecting for?
Thank you very much for that question. Yes, we believe so. Our valuation currently reflects basic key fundamental factors and CAP's ability to sustain its cash flows into the future. As seen recently, past 2 weeks, these technical indices have begun to reflect the fundamental prices at 60% of these moving averages and technical indicators now indicate a buy recommendation. So yes, it is possible within the time horizon to reflect that target price. Thank you.
In addition, we believe this is really attainable in terms of the technical analysis is more of an analysis about the past, and we have factored in our evaluation and also our assumptions about the future that we believe would drive and engage market value. Thank you.
If we go to slide 23, where you basically show your revenue growth assumptions, how do those revenue growth assumptions compare to management guidance and consensus expectations?
Thank you so much for that question. Now, if we would take a look at the breakdown of our projections for revenue, we see that management has stayed committed to investing in research and development. Just in 2022, they completed the application of the upgrade of their ERP software that was able to employ them to engage more efficiently. Now, 2023, management has indicated the need for business analytical tools to get a picture of what the market is saying, to get the heart of their consumers in the end, so that they could integrate these business analytical tools into their ERP software. One of the commitments they have to investment into research and development. Now, looking at the expansion of their local footprints, their retail footprints locally, we've seen a projection of the color centers that these businesses operate. They currently stand at 109, but are projected to hit about 194 in 2028. More so, the growing construction and real estate sectors in the country poses a bountiful opportunity for this business. And so that is another means in which management will be taking advantage of the macros and the commitments of government policy to increase their revenue.
May I please rephrase my question? Is your 14% projected compound annual growth rate higher or lower than management guidance and consensus respectively?
Currently, there are no management guidance backing this. This is based off our team analysis and our team projections. Thank you.
Thank you. Does the company have any exchange rate risk?
Thank you very much for that question. If we could go to the slide on sensitivity analysis on financing activities on Forex, yes. So a very pertinent macroeconomic factor affecting chemical and allied products PLC is foreign exchange pressures. And this is reflected in the fluctuation of the naira to the dollar. Recently in Nigeria, the naira has actually been fluctuating and has gone up to as high as 1,500. Now, according to our sensitivity analysis, the worst case scenario is if the naira hits 2,000, and our target price as a result of that would reduce to 27 naira. But the remarkable thing about this is it still falls within our buy margin. So yes, our company is affected by foreign exchange pressures, but as given the worst case scenario here, it still falls within our buy margin. Thank you very much.
Thank you. There is no hedging, right? That the company does, or is there?
No, there isn't. Thank you.
Going to slide 30, what is your risk-free rate and how did you compute it?
Thank you very much for that question. If we could go to the appendix on cost of equity, the appendix of cost of equity. Yeah, so the current risk-free rate that we apply is 14.386% for the discrete period, and that reflects the yield on the 10-year federal government of Nigeria book. Thank you very much.
And how did you compute your beta?
All right, thank you very much. If we could head on to ESG adjusted beta in the main slides. So we have, first of all, linear regressed the market price of CAB in line with that of the NSE ASI, that is the local index here. And we arrived at a beta of 0.31. This was then adjusted through the Bloom process. So,
thank you, University of Lagos. At this time, the judges will take a few moments to collect their thoughts and make notes before the next university is brought in. Welcome, Qatar University. At this time, please launch your presentation and make sure it is working properly.
Yes. Is our screen visible?
Yes. Please stay muted unless you are speaking. I will start time as soon as a member of your team speaks their first word. You will receive a 1-minute warning and time will end precisely at 10 minutes. Please feel free to begin.
The story of Nakilat is one of claiming control. A kingpin in the Qatari LNG value chain, Nakilat has navigated rough waters and has emerged as a beacon of stability in the Qatari stock market. We are Team Qatari University and we issue a buy recommendation for Nakilat, with a target price of 5.28 Qatari riyals, representing an upside of 33% from the closing price as of March 31st. Our buy recommendation is fueled by 5 main pillars: an unwavering government support, a strategic location, successful synergies from joint ventures, a stable low-risk business model, and an attractive dividend yield.
Starting in the late 1990s, Qatar turned its focus to the exportation of liquefied natural gas, LNG. Whilst initially large international companies took control of the midstream LNG value chain, the Qatar Gas 2 project changed that. And in 2004, Qatar Gas Transport Company, Nakilat, was formed. The twofold raising the throw for Nakilat are providing an essential transportation link in the LNG supply chain and creating a vehicle for private investment in the industry for its Qatari citizens. Nakilat has gained unwavering government support from Qatar Energy, the state-owned oil company in Qatar, and recently secured long-term contracts for the North Field Expansion Project, Qatar's largest oil expansion project in recent years. Currently, Nakilat holds an impressive fleet of 99 vessels, which is set to expand even further with the North Field Expansion Project. Amongst these vessels, Nakilat possesses 69 LNG carriers that enable global reach, leveraging Qatar's strategic location. Nakilat has 3 main business segments: LNG transportation, shipyard, and marine services, with the LNG transportation segment generating 77% of Nakilat's revenue, primarily from wholly owned vessels, followed by shipping joint ventures. Joint venture income has grown by an average of 18% over the past 5 years, with Maran, Nakilat, and other shipping joint ventures accounting for 80% of Nakilat's total joint venture income in 2023.
The LNG industry is seeing a strong confluence of growth: rising LNG demand, expanding liquefaction capacity and supply, and increasing fleet sizes by major players. This positions Nakilat well in order to leverage its experience and well-sized fleet to meet the growing demand as well as support upcoming projects. Nakilat thrives in a niche within the LNG shipping landscape. Dominant in the MENA region, they compete with established global players from Japan, Malaysia, and Australia. High entry barriers and minimal substitute threats further strengthen their position. However, factors like negotiating with charterers and limited shipyard availability for new vessel construction can create pressure on the firm.
In charting a course towards sustainability, Nakilat anchors its commitment through a number of initiatives, from transitioning to zero ODP in 2020 and providing round-the-clock health checks to its business continuing management workshops. We see this reflected in their improved ESG scoring throughout the years. When compared to its peers, Nakilat holds a stable but contested position. The company excels notably in environmental aspects relative to the industry, but lags behind particularly with regards to the governmental aspect. This presents Nakilat with opportunities for improvement. Utilizing Nakilat's materiality matrix, we recommend a focus on 3 key issues: environmental transparency, especially in disclosing NOx, SOx, Scope 2 and 3 emissions, enhancing gender diversity in both staff and board, and optimizing executive remuneration policies for an improved governmental score.
In the past, Nakilat's revenue has averaged 3%. During Nakilat's years of expansion, a significant revenue growth was spotted, as can be seen in the year 2020, as well as in the year 2026, in line with the North Field Expansion Project. Another driver is the contribution of the newly acquired vessels to Nakilat's revenue. Lastly, Nakilat's long-term charter agreements with their joint ventures result in a steady revenue stream and contribute to growth. The team also built a robust revenue forecast model utilizing incremental revenue from new vessels as our key data point. Taking the yearly fleet expansion into account and utilizing the long-term charter rate, the team was able to determine the incremental revenue from each new vessel. The team also performed a margins analysis. Nakilat's capital-intensive nature with high depreciation makes EBITDA margin the key metric for assessing its true profitability. Nakilat has a current EBITDA margin of about 75%. This is considerably higher than that industry average of 47%. This is due to the company's operational efficiencies as well as their utilization of economies of scale strategies. Another key driver is unwavering government support in the form of long-term charter agreements with Qatar Energy. These factors, combined with higher revenues from joint ventures and lower interest expense over the forecasted period, contribute to Nakilat's strong operating and net profit margins. Nakilat's CapEx per revenue ratio is expected to reach about 72% in 2026 as the company undergoes strategic investments for expansion. We also estimate a downward trend from 2028 onwards, reaching 55% in 2030. This is due to the contribution of the newly acquired vessels to Nakilat's revenue. Historically, Nakilat has utilized 80% debt to finance its expansion projects. Consequently, Nakilat has an above-average debt-to-equity ratio of about 160%. We can observe a significant decrease in this ratio in the forecasted period due to repayments of existing bank loans and corporate bonds. Nakilat's current interest coverage ratio is lower than the industry average. However, a substantial improvement is anticipated during the forecasted years, reaching 3.69 in 2033, primarily due to the steady cash flow streams from long-term charters and the upcoming expansion further contributing to these revenue streams.
As for the valuation, the team used a blended valuation approach, allocating 60% to the DCF, 30% to the valuation, and 10% to the DDM. This gave us a target price of 5.28 Qatari riyals, representing an upside of 33%. The cost of equity of 7.5% was arrived at using the CAPM model, and the cost of debt of 6.3% is the yield to maturity on Nakilat's long-term corporate bond that is coming due in 2033. This gave us a WACC of 7% for the firm. The DCF model has two growth phases, with 86% revenue growth forecasted in the initial 10-year period, after which a perpetual growth rate of 2% was assumed. This gave us a enterprise value of 36.1 billion Qatari riyals and a target price of 5.46, giving us an upside of 37%. As for the relative valuation, because of the capital and the debt-intensive nature of the industry, the team considers the EV/EBITDA as the pertinent metric for relative valuation. Taking into consideration 5 global peers in the oil and gas transportation sector, the EV/EBITDA multiple provides us with a target price of 4.67, giving us an upside of 18%. And the PE multiple gives us a target price of 4.98 Qatari riyals, representing a potential upside of 25%. Keeping in mind Nakilat's generous dividend policy, the team saw fit to do a DDM analysis. Keeping the average dividend payout ratio of 61%, which is in line with the historical average for the initial forecasted 10-year period, and then assuming a 2% perpetual growth rate, we get a target price of 5.75 Qatari riyals, giving us an upside of 45%.
In order to visualize the impact of sensitivity in 8 key variables, the team has developed a tornado graph. The long-term charter rate is the most impactful, directly affecting Nakilat's revenue. WACC follows closely. A 20% decrease boosts our target price by 22%. Terminal value is another crucial factor, representing 77% of our enterprise value. We also conducted a stress test by changing 3 variables to get a bull, bear, and base case scenario. In the bull case scenario, we have a 75% upside, giving us a buy recommendation. In the bear case, we have a 15% downside, indicating a hold. Our team also conducted a dynamic sensitivity analysis using a 2-variable data table and Monte Carlo simulation. For the sensitivity grid, after varying 2 key components of the terminal value, our buy recommendation is now fortified with an 88% probability. The Monte Carlo simulation targeted 3 pivotal factors: long-term charter rates, terminal value, and WACC. And after running 30,000 simulations, we arrived at an astounding 98% confidence level with a mean price of 5.28, cementing our buy recommendation across the board.
We identified various risks to our valuation, which we categorized based on level of probability and impact. The market risks for Nakilat impact its market share in the LNG industry. Their dependence on Qatar Energy for long-term contracts presents an operational risk. The current Red Sea tensions pose the biggest risk to our valuation. This is because the Strait of Hormuz, a critical route for Nakilat's vessels, could be impacted by any escalations. In order to quantify the possible impacts of this on our recommendation, the team conducted a scenario simulation. As Nakilat is engaged in take-or-pay contracts with full cost pass-through, including insurance to charterers, the impact on the firm's operational costs is minimal. Yet, the investors' sentiment could suffer. Overall, our simulation reinforces our buy recommendation. Taking into consideration the merits and concerns of our valuation, we reiterate our buy recommendation for Nakilat with a target price of 5.28 Qatari riyals with an upside of 33%. This has been Team Qatar University. Thank you for listening.
Thank you. Judges, at this time, please turn on your video.
Please stay muted unless you are speaking. I will start time as soon as a judge speaks the first word. The Q&A period will be at least 10 minutes. If it is still going after 10 minutes, we will continue for up to 15 minutes total. If any time after 10 minutes the judges have no remaining questions, we will end the Q&A period before 15 minutes. Please feel free to begin.
Thank you for the presentation. In your opinion, is it a growth stock or a value stock?
Absolutely. I'd like to take the question. Thank you so much for the question. My name is Wirtualna, and for Nakilat, we would classify Nakilat as a defensive stock because of three main factors. Firstly, Nakilat has a very low beta compared to the market. We have 0.64 as Nakilat beta. Secondly, Nakilat is a defensive stock because of the very stable nature of its business model. Because of its reliance on long-term contracts, we have very steady dividend payout ratio for the dividend payout ratio for the firm, because they are able to sustain high revenues and also service their debt in a good fashion. So because of these factors, we consider Nakilat as a defensive stock, which is how it's viewed by the market as well, and hence resulting in the beta of 0.64.
Thank you for the presentation. Go ahead.
You are forecasting some growth in the area of 6, 7 to 11%. So my question is, why are margins staying constant while the company is growing its revenues?
Okay, my name is Arif, and I'll be taking that question. If you could please move to Appendix F3. Yes, as mentioned earlier in the presentation, the team performed a margin analysis, and from this we determined that the EBITDA margin, net profit margin, as well as operating margin of the companies are continuously increasing throughout the forecasted period of 2024 to 2033. And this increase is a result of the company's operational efficiencies, as well as their utilization of economies of scale strategies. In addition to this, the net profit margin and operating margin are increasing as a result of an increasing investment income, as well as decreasing interest expense due to repayments of bank loans, as well as corporate bonds throughout the forecasted periods. So what the team has observed is an increase in these margins throughout the period.
The EBITDA margin is staying constant, right?
Yes, absolutely. So in order to address that point, the EBITDA from Nakilat remains constant because of the very fact that depreciation and amortization for Nakilat has remained constant over the past years as well. It's about 2.5%. The depreciation is 2.5% of the gross fixed assets. And this is because all their vessels have been acquired with a useful life of 40 years. Because of this very reason, we see EBITDA margin as constant, but much higher than the industry.
Thank you.
Thank you for the presentation. Question regarding your weights for the valuation. Do you think that attributing 30% to relative valuation, do you think it's conservative or not, especially given that it's guiding for a lower target price versus the DCF?
Absolutely. I would love to take that question. So when we started learning about Nakilat's story in the very first initial phases of our working for the challenge, we realized that relying on just the DCF model would not be sufficient, given the fact that DCF model is based on many assumptions. And whether these assumptions come true or not is up to the future. And because of that very reason, we wanted to have a more comprehensive analysis. And that's one of the reasons we wanted to do a relative valuation as well and get an accurate price for the firm. So we wanted to do a relative valuation with two key metrics that would be pertinent for Nakilat. And that is why we allocated a higher weightage to EV/EBITDA, given the capital and the debt intensive nature of the industry. And again, we wanted to do a DDM analysis as well because of the high dividend payout ratio for the firm. So we wanted to ensure that we get an accurate price for the firm. And that is why we decided to diversify our weightage for the valuation model.
Hello, my name is Lina Mohammed, and I just want to add on one point. As why the reason we've given such a lower weight to the relative valuation in general is because of the fact Nakilat operates relatively isolated in the Middle East LNG shipping industry. We don't consider the fact that Nakilat having any direct or exactly comparable peers in the region. And although we use a thorough screening process for arriving at the peers based on their involvement in the energy shipping, their fleet size, and the industry classification, we still believe that peer valuation should have been given a lower weightage.
Thank you.
Why do you think there is a big discrepancy as per the company's different positioning versus peers in different ESG scoring platforms like Refinitiv, Bloomberg, etc.?
Thank you for that question. My name is Fatima Norha Mahroof. And I believe that the reason for why there's such a discrepancy in Nakilat scoring versus the peers is because, as we have mentioned, they have their strengths, but they also have their weaknesses. And one of this is diversity. And compared to its peers, Nakilat is actually quite weak in this area in terms of its peers. It actually has zero representation in terms of female representation on the board and also in higher levels in the staff. So these such aspects, and also the fact that Nakilat also does not disclose its SOx values on top of its scope 2 and 3 emissions. These are things that not only make it very hard for Refinitiv, Bloomberg's, Sustainalytics, and even like other platforms. It makes it hard for them to value them, give them the scores, but it gives an inaccurate representation when there is not as much data available or insufficient data available. But with the data that is given, we can see that they do have their weaknesses, and that is why they have compared discrepancies.
How did your ESG analysis inform your valuation or your investment decision?
Absolutely. I would like to take that question. So as my colleague had mentioned previously, we need to take into consideration the market dynamics in Qatar and the Middle East in general in order to answer this question. So the ESG reporting in Qatar is not yet mandated. And because of that very reason, we have a very low amount of data that we can use, or we lack the strong data that we would need in order to take that into account in our valuation. And this is why we want to make sure that our valuation is free of any sort of inaccurate data or data that is not based on strong foundations. And we wanted to keep the valuation based completely on the company's operation. Yet we wanted to do the ESG analysis in order to see how the market perceives Nakilat's ESG performance. And because of the very fact that the world is moving towards sustainability, and it is important to understand how does a firm operate in each of the ESG pillars.
So you did not incorporate ESG into your valuation, is this correct?
Yes, we did not want to do it because of the fact that we do not have sufficient data in order to incorporate that into any of our assumptions in our valuation.
I would also like to corroborate with what my peer has said. Also, as my peer has mentioned, because it is an emerging market, there is not as many regulations, and therefore the cost of having, not having ESG practices is not as detrimental to companies in operating in the Middle East as it would be in other developed countries, and therefore it would not be accurate to incorporate ESG into the valuation at this time, but we are aware that ESG is growing, and ESG considerations are something that we need to take into our minds, and therefore we have also looked at it because we are understanding the importance of it.
Okay, and staying on ESG, did you look if the company is following or targeting any SDGs?
Yes, actually, Nakilat is targeting SDG 15, I believe, and also SDG 17. And also they're targeting many other areas, not only the SDGs, but also, for example, they're also following IMO 2020 regulations and a lot of other global regulations. And also they have transitioned from, they have transitioned to zero ODP in 2020, again, in adherence to IMO 2020 regulations, which again, is in adherence to the UN's SDGs.
Okay, and did you incorporate any of this in your model? increased costs or in some other way?
Yeah, I would like to answer that question. So as my colleague had mentioned, one of the ways in which they are reaching their environmental goals is by acquiring MEGI and XDF vessels. MEGI and XDF vessels are known as the more environmentally friendly vessels, and this is what Nakilat is going to be acquiring when they do the 25 fleet expansion, which has been confirmed by the news. The $270 million of cost that we took into consideration for the vessels in our capex, in forecasting our capex, is how we've taken into consideration the vessel cost for MEGI and XDF vessels.
Thank you.
So why do you think such upside potential is missed by the markets? What do they not see or undervalue?
Thank you for that question. My name is Leena Mohammed, and I'll happily take that question. So the reason that we're seeing Nakilat's share price being so undervalued, with the market price today being 3.79 Qatari riyals, compared to what we calculate intrinsic value of 5.28 Qatari riyals, is mainly due to the market dynamics in Qatar. Qatar is actually still an emerging market, with the Qatar Stock Exchange lacking market depth and value, unlike others we see in more developed stock markets. With just around 50 companies listed in the Qatar Stock Exchange, we still see lower trading volumes, depth, and limitations of financial instruments. Therefore, investor sentiment around Qatar is still not up to the mark. And therefore, because of this reason, sound companies like Nakilat are still not able to reach their intrinsic value.
If you go to your sensitivity chart.
Yeah, would that be our tornado graph?
Yes. Your base case. How does your base case compare to your revenue growth assumption for your valuation?
Sure. So for the base case scenario, we have a revenue CAGR of 6.07%, which the main component of this is the long-term charter rate. So we varied our long-term charter rate in order to see what the revenue CAGR would be in the bull case and the base case. And in the base case, our long-term charter rate is 95,000. And in our bear case, we use the long-term charter rate of 85,000. And in the bull case, we have a 105,000. Doing so gave us these revenue CAGRs that we can see in the bull and the bear case, which resulted in a huge upside of 75% for the bull case and a 15% hold for the bear case.
But the 6% in your base case, how does that compare to your assumptions in your revenue forecast?
Sure. So the 6% of revenue CAGR that we have is related to the revenue that they have forecasted. I'll just quickly pull up our revenue forecasting. 1 minute. Yes. So we have the forecasted revenues here. These are based on vessel acquisitions of 25 vessels over the next 10 years, and we have all of them operating at full capacity in the whole year with a daily charter rate of 95,000. As you can see, in 2026 and 2028, we see the highest growth rate because this is when the company begins acquiring its vessels. And we see the highest revenue growth into the 2028, given the fact that we are assuming four vessels being acquired in this year. And this is what is contributing to the CAGR.
But if you take a compound annual growth rate of all your assumptions here, right?
Yes. Yes.
How does that match your base case scenario?
If I'm understanding your question right, how does the CAGR of 6.07 relate to our base case scenario?
Correct.
The base case scenario is built, our revenue forecast here is built on the base case scenario of 95,000. So this is the scenario in which we have a revenue CAGR of 6.07. We varied the long-term daily charter here above and below to get the bull and the bear case CAGR. So our base case is based on our revenue forecast and the model that we've created.
Thank you.
You spent some time on debt to equity and interest coverage ratios. Can you guide me through the capital structure and show me some solvency and liquidity ratios, please? Other than those that you showed on the slides.
I can do that. We have the financial ratios here for the firm, and as you can see, the main liquidity ratios that we have taken are the current ratio and the quick ratio for the firm, which is for the short-term liquidity. But we believe that this is not pertinent as such for Nakilat because most of their liabilities are for the long term. And because of that fact, we want to look at the times interest earned ratios for Nakilat.
Qatar University. At this time, the judges will take a few moments to collect their thoughts and make notes before the next university is brought in.
Thank you.
Welcome, Otto, Beisheim School of Management. At this time, please launch your presentation and make sure it is working properly. Please remain muted unless you are speaking. I will begin time as soon as the first member of your team begins speaking. You will receive a 1-minute warning and time will end precisely at 10 minutes. Please feel free to begin.
Dear jury members, today my team and I are going to present our equity research report on Deutsche Lufthansa AG, one of Europe's aviation giants. The WHU Equity Research Team issues a sell recommendation on Deutsche Lufthansa AG. As of March the 28th, the Lufthansa stock price stood at 7.28 euros, and we issue a target share price of 6.16 euros, indicating a potential downside of 15.3%. Lufthansa, founded in 1953 and headquartered in Cologne, Germany, has grown to become Europe's leading aviation company by revenue. Lufthansa operates through 3 main business segments. First, its passenger airline segment, which comprises a large portfolio of diversified airline brands. Second, its logistics segment. And third, its maintenance, repairment, and overhaul services, also known as MRO services. Lufthansa's international outreach and its revenue concentration of 60% within Europe demonstrate its market dominance. However, if this now sounds like an attractive investment opportunity to you, please fasten your seatbelt as we embark on our journey through our sell recommendation. 3 main rationales anchor our analysis. First, macroeconomic sensitivity exposes Lufthansa's risk profile. Lufthansa's operations are highly sensitive to economic fluctuations, especially within Europe. Second, aggressive competition will undermine margins. The intensifying competitive landscape within the industry, especially due to low-cost carriers, will erode Lufthansa's profit margins. And third, German base leads to a structural disadvantage. Now, with these 3 theses in mind, let's delve into the industry's dynamics. The German travel sector's recovery from COVID-19 presents a rather concerning outlook. Leisure travel remains 23% down compared to pre-pandemic levels, and business travel, which is a key profit generator for Lufthansa, lags even further behind, with 30% down. Now, this is not just a mere transition phase after COVID-19, but rather reflects deeper and lasting changes within the industry. And this is due to 3 main factors. First, a shift towards remote work. Second, corporations cutting their budget cuts for travel options. And third, we see an increasing awareness for more sustainable travel options. These factors reshape demand dynamics and travel behaviors.
Lufthansa experiences high pressure from its competitive positioning. On the demand side, relative to its peers, Lufthansa offers poor quality for high prices. Ticket prices per kilometer average among the highest in its industry. However, the quality of its service has decreased in recent years and fallen behind the competition. Hence, aggressive competition will decrease margins, as we mentioned in our second investment hypothesis. While on the supply side, as Lufthansa is German-based, the wage level of Europe is reflected. Lufthansa already has, together with Air France, the highest staff cost in Europe. In the future, the shortage of European pilots will increase, and so will the cost for personnel do.
Let's now take a look at the financial analysis.
The first thing I would like you to notice is the sharp drop in revenue and EBIT margin in 2020 and 2021. Of course, this was due to the COVID-19 pandemic, but it again highlights Lufthansa's sensitivity to the macroeconomic environment, which is our first cell rational. Looking at the future, we expect Lufthansa to bounce back to pre-pandemic levels and then reach its long-term revenue growth rate of 1.5% by 2030. Overall, revenue growth will be 20% until 2030. However, if you take a look at the yellow line, you can see that EBIT margin will actually decline. Why is that? Well, looking at the cost drivers, you can see that all major cost drivers exceed the 20% revenue growth. So of course, more margins will decline. We also forecasted that in the earnings per share, which we predict will decrease from €1.50 in 2023 to €1.18 in 2030. Looking at the valuation, we came up with a target price of €6.16, representing a downside of 15.3%, and we used a 50-50 blended approach of DCF and multiple valuation. Both our DCF model and the multiple valuation confirm our sell recommendation. However, if you take a look at the multiple valuation, you can see there's quite some deviation between EV/EBIT and EV/EBITDA multiple. This is because Lufthansa as a group structure is a little bit different than some of the other airlines. This is because it also has the MRO services segment and also a very large logistics segment. So therefore, depreciation, amortization, and rental expenses, which are mainly for the aircraft, will be less in comparison to revenue than with other airlines. With this in mind, it makes sense that there's some deviation between EV/EBIT and EV/EBITDA multiple. Taking a deeper look at the DCF, we came up with a target DCF price of €6.05 using a WACC of 7.63%. This WACC is very close to what Lufthansa also reports in their own annual reports. Looking at the sensitivity table, you can see that our sell recommendation is actually very robust and still holds when changing some of the assumptions. Finally, taking a look at the EV to equity bridge, you can see that Lufthansa has very high interest-bearing liabilities. This means that it's again very sensitive to the macroeconomic environment. So for example, changes in interest rates will have a huge impact on Lufthansa's financial position.
Lufthansa's ESG profile is a critical block in our analysis of long-term diminishing margins. We've pinpointed three major challenges: carbon emission, human capital, and product governance, which all contributed to Lufthansa's lower ESG rating in the peer group. Environmentally, to navigate aviation net zero by 2050, Lufthansa is committed to large offtake agreements of sustainable aviation fuel. However, it lags behind in the race of fleet modernization. Given its large fleet size and average age of 13 years old, Lufthansa's fleet will only be carbon emissions of 30% by 2030, while its competitors gain advantages over cost and efficiency. Socially, Lufthansa faces persistent tension with German labor unions. Their pilots, flight attendants, and ground staff, who are fundamental to their operations, are constantly embroiled in a cycle of negotiations, strikes, and temporary agreements, worsening Lufthansa's high labor costs. These strikes not only have financial implications, but also resulted in above-average flight cancellation rates and a 52% decline in customer satisfaction scores. As customers start to seek alternatives, Lufthansa's once premium strategic positioning is now at risk.
We identified four main threats and possible deviations to the assumptions of our investment hypothesis. They are especially a symptom of a structural disadvantage of a German base. Most important, our estimations could be negatively impacted by profitability concerns and unrealistic targets. Inflation and rising costs influence profitability critically, but are hard to predict. As we mentioned in our investment thesis, operating in a global market economy, Lufthansa is very sensitive to geopolitical risk and security concerns. Within the last years, the global conflicts only seem to increase. Moreover, Lufthansa is subject to German as well as European regulation. It faces operational vulnerability due to staff shortages and must navigate regulatory hurdles. Macroeconomic sensitivity exposes Lufthansa's risk profile. Aggressive competition will undermine margins. German base leads to a structural disadvantage. We, the WHU team, issue a target price of 6.16 euros with a downside of 15.3%. Our intensive research on Lufthansa only allows us to issue a sell recommendation. Thank you. We are looking forward to your questions.
Thank you. Judges, at this time, please turn on your video. Please stay muted unless you are speaking. I will start time as soon as a judge speaks the first word. The Q&A period will be at least 10 minutes. If it is still going after 10 minutes, we will continue for up to 15 minutes total. If any time after 10 minutes, the judges have no remaining questions, we will end the Q&A period before 15 minutes. Please feel free to begin.
Thank you very much for your presentation. My first question relates to ESG. How does your ESG analysis inform or drove your investment decision or your valuation?
I am happy to take this question. So we already see, can we please go to slide financial analysis? One sec. Yeah, so we identified ESG as cost-driving factors for Lufthansa, especially the fuel costs, as I mentioned, SAF, sustainable aviation fuel, which will be 2 to 4 times more expensive than the normal fuel price. And given this optimistic view, if we go to appendix slide, 59, we have modeled this fuel cost increase on Lufthansa's net income with positive case and worst case with a difference of 2.5 million euros. And on the other side, the labor costs is also already incorporated in the valuation models.
Yeah, I think maybe one final thing to add, if that's possible. So also we modeled the increase in the modern planes. So right now Lufthansa is still lacking behind, I think, as was said with by Jackie, and we do expect it, so therefore also we expect depreciation to increase. We do expect increased capex, increased expenditure for newer planes, and then also of course the depreciation to increase as a result of that.
Thank you. I have a follow-up question on fuel. How strong is the pricing power of tickets to pass on higher fuel costs?
As we elaborated in the ESG part, we the decline in customer score suggests that customers are not so willing to take over a higher prices. We already see that customers have Lufthansa has the second highest price with Air France. So we see that they have a limited power to pass on this cost inflation to customers.
So do you think they are unable to basically impose fuel surcharges whenever needed?
No, like of course, if the whole airline industry is going to get more expensive, they're able to pass on some of the prices. But I still think, for example, alternatives such as trains are going to get more, are going to remain the same price. So there's going to be some substitution effect there. Of course, also again, cargo, you have like planes are already really expensive. You have some substitution effect there as well. I think, of course, they're able to enforce higher prices, but will margins stay the same? I kind of doubt it. And I also think overall maybe the demand will decrease a little bit. But I mean, I guess, of course, they will be able to increase prices if all airlines are affected by that. And also maybe just one tiny thing to add. They also hedge their fuel costs, of course, for 1 year in advance. So the impact will also not be immediate. But I think also, as you can see from this slide, there will be some impact. Like it's not something that you can just ignore in the evaluation.
Thank you.
Thank you. You answered my hedging question. The second question is regarding the total load factor. Can you comment a bit about that? And if it's highest among peers, is it sustainable? If it's the lowest, can it be improved?
Yeah.
Also, like I don't think we have it on the numbers here, but we analyze this data and their load factor is about 80%, all combined in the groups, including cargos. So it's not too bad for the airlines. It's about average. And we think also Lufthansa commented this themselves that last year the load factor was especially good because of after COVID recovery, and they didn't recover the capacity fully. And so customers were more full on the plane than usual. I think it depends on how much they plan the recovery and how fast this market recovers. In the previous years, it didn't have as good as 80% load factor.
Yeah, there's also one thing that I think all airlines right now are increasing their capacity, especially in the long haul. I think Lufthansa is kind of marching away with that too. So there's also some question if, if they're able to hold the load factor, if they maybe have to decrease prices a little bit. So there's also some profitability uncertainty in that regard, as when they increase their number of planes, if they're still able to keep the premium pricing, or if they have to decrease it a little bit. It is another uncertainty for sure.
Okay, and can you show me the multiples of Lufthansa and their peers, and make a comment about this, please?
Oh, it's in evaluations, 47, no, 48, no?
Yeah, for 53, was on the other side, on the other side. Yeah, I can take it, you can, I don't mind. So maybe to start with, so I think you see that there was, or I mentioned that there was quite some deviation between EV EBITDA, and I think you can see quite clearly here also Air France. If you look at the EV EBITDA here, they're fairly low because they also have the MRO services segment, so they again have I would say the closest group structure to Lufthansa, so therefore they have very similar multiples. Another thing also is, why did we choose 2025? The reason for that was because Lufthansa was a little bit slower to catch up to the revenue and margins and so on than the other airlines. So Germany, the German market recovered a bit slower. So we thought we would use 2025 when there's actually some normalization, rather than, let's say, 2024 when there's still quite a lot of deviation between the revenue, in revenue between the airlines, which would kind of skew the results a little bit, or skew the valuation a little bit.
Okay. Thank you. One other small question. Why did the service quality drop in the recent years?
I can take this one. Well, Lufthansa was awarded with a very good grade of the Skytrax achievements for the quality of aviation companies. So they had a really high position within the international quality landscape. However, they weren't able to keep up with that because certain innovations which they had planned for seats, for example, didn't really come to effect, and they weren't able to implement them. And the high award that they got previously was based on this planning that they would incorporate new business seats and stuff like that. And they weren't really able to implement that. And further, we also have the problem that certain labor unions are repeatedly striking, and hence the customer satisfaction or decreases again, as, for example, flights get canceled or delayed because Lufthansa isn't able to keep up with their service.
As a follow-up question to that, how do you interpret the fact that Lufthansa service quality is deteriorating, but is still ranked second in terms of ticket pricing? And where will you place the company going forward on ticket price ranking in Europe? And my second question is, you mentioned at some point unrealistic targets, which I assume is shared by the management. What are these targets, and have you looked at the past targets given by the management versus realizations for Lufthansa in key performance metrics?
I'm also happy to take the first question. Well, we can see that on the one hand, Lufthansa has very high prices right now. But on the other hand, we also know that due to the decreasing quality, Lufthansa has to adjust their prices sooner or later. We also see the high rivalry within Europe due to the low-cost carriers such as EasyJet or Ryanair, which really push on prices, and hence Lufthansa has to also decrease their prices if they want to stay competitive. And further on, for the long haul, as Carl already mentioned, other aviation companies are also revving up their long-haul fleets, and hence there will also be more competition within the long-haul flights. And this will also have an impact on Lufthansa's prices. And we believe that Lufthansa has to go down relative to the competition with their prices in order to stay competitive and also to compensate for the lower risk and also the unpleasant features that customers get due to the labor union strikes.
And maybe referring to the targets in the past, Lufthansa's positioning was way better than it is now. And so the situation changed a little bit. We looked at the old targets and they more or less, especially less, reached them. But the positioning 5 years back, if you look at the stock price, was completely different. So they are now really under pressure first, and the uncertainty in this world only increases also with the war in Ukraine, the nearly war in Israel, and the Houthi rebels in the Red Sea. So the uncertainty globally, as Lufthansa is very sensitive to global politics and sensitive to it. The global conflicts are make uncertainty much more factor in our calculations.
How did you derive your 1.5% terminal growth rate?
Yeah, I'm happy to take that. So first of all, let me just start to say that this is a nominal growth rate and not a real growth rate, so just that we're on the same page. I think if you look at inflation, what it is historically, what we expect in 2030 to be, I think historically was always below 2%. I think sometimes even below 1%. We kind of modeled it marginally above 1%. So that was kind of the baseline for inflation. And then looking at the long-term growth rate of Germany, we estimates are around 1 to 2% in Germany. Again, real growth rate in this case. However, if you look at the first of all, if you look at the aviation sector in general, I think it's not really a growth sector. I think because of the increased competition, because of the SAF pricing, because of the substitution effect, because of taxes, there are many reasons why it's not really a growth sector. It's also very mature, so it's not going to be the main growth driver for that. And then I think additionally within the airline industry, Lufthansa is not really positioned to really grow. So I think even if the aviation industry itself grows maybe like 1%, we expect the growth of Lufthansa to be marginally positive. So if you have long-term inflation of just above 1% and Lufthansa's growth rate marginally positive, you get to the 1.5% of growth. I think maybe just on another note, if you also look at other equity research, they sometimes have a little bit higher, but then they also have a WACC much higher. So I think, there's quite a wide range of deviations between what different, let's say, equity research report, what the different analysts believe. But I think so there is some argument, for example, if you look at this table, to kind of move in the top right corner a little bit, where the terminal growth rate is a little bit higher, but then also the WACC would be higher. There's some argument there, but I think that's how we decided upon it. I think there's no exact, different analysts make different assumptions, and that kind of how it goes.
Thank you.
Okay. Given your seller recommendation, lots of uncertainty, if you were to magically become a CEO tomorrow of Lufthansa, what will be the first thing you do apart from adjusting prices?
I'm happy to take this one. I think one major problem are the union strikes. There have not really been any good conclusions and solutions for these ongoing strikes. And I think this is a problem which kind of Lufthansa always has due to the German labor unions, but also has to deal with it in the future. We have seen, for example, right now in March, there were contracts made with certain labor unions which agreed upon no strikes for the next upcoming travel season. However, these were only short-term agreements, and Lufthansa had to move back with their demands and take the demands of the labor unions in order to provide the services to their customers. So I think the labor union problem is one real problem that Lufthansa has to tackle. And also another thing, I think regarding the competition, there is a lots of M&A action also happening within the industry. And I think there are many opportunities to also start acquisitions of other airlines in order to increase market share and hence build up a better and stronger position within the competitive market.
I think one thing to add is kind of our sell recommendation is really long-term and is not necessarily focused on like the management. Like I think it's the problems we identified are not things you just fix in the next year or 2 years. I mean, they're broader issues. I think that's a big factor.
Thank you, Wu, Otto, Beisheim School of Management. All 6 teams have now presented. At this time, the judges will begin deliberating. Please make sure to rejoin the Zoom session in about 30 minutes to hear which teams are advancing to the global final.
Welcome back and thank you. Welcome back and sincere congratulations. We've heard some remarkable presentations today. The level of thought, attention to detail, insightful analysis, teamwork, presentation skills. I could go on, but you really have impressed the judges and all of the other audience members today. So hearty congratulations. Use the experience, put it on your CV. Offer it up in job interviews. Be ready to talk about what you learned, what went well, things that you would do differently another time. Thoughtful reflection is the surest way to impress an interviewer in a job interview. So be ready to talk about this experience, every element of it. Every team today has already enjoyed significant success. You've come a long way in this competition, but sadly, only 2 teams can proceed to the CFA Institute Research Global Final. So no more waiting. The judges have scored all teams and the results are in. The 2 teams that will be presenting the Europe, Middle East and Africa region at the global final in Warsaw, Poland, on the 16th of May are Qatar University and WHU Otto Beisheim School of Management. So thank you to all the teams and judges for your hard work and dedication. Thank you to our global data services provider, London Stock Exchange Group. Congratulations again to the 2 teams who are advancing to the global final. Samantha will be in contact with advancing teams by early next week, but we really want to congratulate you all on amazing performances today.